Property investors really holding back first home buyers from getting into the market. An interesting report by the Australian House and Urban Research Institute showed that many tenants are not keen, at this stage anyway, to get into the housing market to buy a home. They're renting for all sorts of reasons, which we'll explain in this week's Property Insider Chat, and it shows that somebody has to provide accommodation for them. So this week, Dr. Andrew Wilson and I explain about the important role of property investors and why you shouldn't demonise them. We also talk about a number of economic factors, including wages growth, house building cost, and how spending has been going, which give us an indication of what's ahead for our economy. If you want to keep up to date with the property market and the economy, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. As I look back over the last year, I've noticed an interesting trend. The media and a number of political parties seem to have property investors in their sights, portraying them as greedy and portraying them as locking out first home buyers from the market. In the 5 decades I've been involved in property, the role of property investors has never been more scrutinised. I've never seen as much of us and them, which I don't like, this us and them mentality, and property investors have been demonised. But amidst this debate, there's a critical aspect that's been overlooked. Property investors aren't necessarily villains, not like they're made out to be. Instead, they're providing a vital service by housing a significant portion of Australians who, for various reasons, either can't or don't want to buy their own home. While in many countries overseas, the governments provide this sort of service, in Australia, it's left to rental property providers, mums and dads, who run a small business of providing long-term accommodation. And in spite of what the media would like you to think, not all tenants want to buy their home. So in today's Property Insider Chat with Australia's leading housing economist, Dr. Andrew Wilson, I'd like to get his thoughts on some recent findings of the HAURI, a report they made which showed the reasons that many people rent. And I'd also like to get his update on a number of economic news items as well. Hi, Andrew.
Yeah, good day, Michael. And I'm not sure it's a sort of a new atmospheric in terms of the commentariat in regard to demonising investors. I think, the nonsense that the media portrays in regard to the property market has been, evident for decades, I think. Certainly the last decade, they keep getting it wrong, hence all those ridiculous predictions of house price crashes, which just never, ever occur. And of course, the opposite, we get very strong periods of growth. But of course, it's all clickbait. It's just designed to generate, some sort of income for what is clearly a failing business model. And I think there are some really big picture items here, Michael, if I could just continue. And I think even, some of the political parties are waking up to this. Australia is a very aspirational country. We really don't have that sort of class stratification that I guess a lot of us came out of in our sort of our migration journey. And there's millions of investment properties out there. Most of them just have single owners, so it's not as though there are swathes of slumlords that are taking advantage of those who can't get into the property market. And I think another point to make is that that a lot of our new migration ethnic profiles, particularly the Chinese, are very attached to investment property as a mechanism for wealth building. So I would suggest to political parties that are, wanting to, sort of attack the, in terms of tax policies, particularly investors, that they should be very, very wary of the political consequences of this, which we are starting to see overseas. And it's a bit of a myth, this sort of the haves and the have-nots, the class envy type of politics that certain parts of our political spectrum are still keen on pursuing, which they don't seem to get the traction. And even that latest Queensland election, Michael, just a couple of weekends ago, saw a significant collapse in the Green vote, and they're front and centre in terms of their, policies, their anti-housing policies. And I think, again, that's a lesson learned. And I think the other lesson is that history tells us that at your peril, attack investors. We saw the previous Labor administration, could we call it that, under Bill Shorten, tried to introduce, or were proposing to introduce, changes to negative gearing as part of their platform. And Mr. Shorten lost what was called the unlosable election. And I'm not saying it was all about that policy, but I think that that contributed to it. And the other thing is, we can just look at some of the positions of state governments recently that have introduced policies that I might say were sort of anti-investor. The Victorian government, needing to, rebalance its balance sheet, has introduced stamp duty changes to, land tax changes for investors. And, that Melbourne housing market is really struggling at the moment. I mean, where the other major capitals are, experiencing very strong growth, house prices are falling in Melbourne. And we're sort of seeing a similar underwhelming performance from the Canberra housing market as well, that they also introduced similar types of policies that were targeting, investors. And I think that, you'd have to be a very brave government or opposition to be thinking about introducing those policies to reduce demand for investors, given that the experience of other governments, but also given the fact that really, Michael, the only way you can, I guess, rebalance the housing market in favour of, I guess, replacing investors with potential first home buyers is to actually cause significant house price falls. Because how else are first home buyers going to get into the market? And I'm not sure the electorate out there would be very happy about an across-the-board fall in their house prices. In fact, I don't think whoever proposed that under those circumstances would be in government for very long, and certainly their support, I believe, would collapse. So again, these are driven by concepts that don't apply to Australia. We don't have the type of wealth disparity that other advanced economies do. We are an aspirational nation. We are a very wealthy nation. Under a number of measures, we're the wealthiest country, on the planet. And as I said, very strong aspiration for wealth building through property investment. So, I think it's just a bit of a hoary old chestnut, a story that's promoted by those that still think we're, in the past century in some sort of a class society of the haves and the have-nots, and trying to promote the politics of envy. And I just think it's a complete failure. And I think in a way, the US election told us a little bit the same story, Michael. Sorry for the long-winded reply, but it's a bit of a hobby horse for me to read that sort of nonsense. And, good luck with political parties that buy into it, but I don't think they'll be around for very much longer if they do.
I agree they shouldn't be splitting us up to have and have-nots, but there's an underlying assumption that they make that everyone who's renting wants to buy a home, and so investors are stopping them. And that's far from the case. We know that in general, millennials are leaving their decision to buy a home later. Interestingly, a recent report from the Australian Housing and Urban Research Institute, which is a left-leaning institution, showed that apart from financial factors, there's lots of renters who choose to rent for lifestyle decisions. Interestingly, they found 10% of renters owned an investment property. So they were rent-investors, and they rented where they enjoyed living, wanted to live, but couldn't afford to, and bought a property elsewhere. Others found it cheaper renting than buying. It was a lifestyle decision. We know a lot of migrants coming to Australia will rent for 3 to 5 years before they buy. Others have got married, got divorced, moving house, maybe new job. They're not sure where they're going to be. So somebody's got to provide the accommodation for them. Somebody's got to provide housing for, well, almost a third of Australia's population, because the government's not doing it, are they, Andrew?
No, they're not. And I think, doesn't logic tell you, given that we've still got very, very tight rental markets across Australia's capital cities, that we need more investors, not fewer investors. And I think that the whole story about Australia's housing market, which by and large, works better than most, if not all, is that the rental market is the first port of call for those moving onto the property ladder. That's the queue. People are in the queue, they rent until they can build up the wealth or the financial attributes to allow them to purchase. And the only way you can accelerate that, as I said, is by having lower prices, and that would mean, and if the investors are the target for that, that would mean a catastrophic falling off of investor activity, which would only come through lower prices. And there's been a lot of nonsense also reported regarding the activity for investors over the past few years. There was some research, which I find highly questionable, that showed or apparently proposed that investors were selling their properties. And yet the real data in terms of home lending has seen an absolute surge in investor activity over the past 2 years. So investors are still very keen to be part of the property market. And of course, they're providing shelter for those that are on the ladder and working through to the point where they can afford to move into the property market as owners rather than renters. But it's just clickbait, Michael. And Ahuri who were once I was an associate of Ahuri. They're a very credible organisation, and that's interesting that their research is debunking a lot of that mythological, ideological claptrap that we get in regard to investors and their position in the housing market.
Right, you're right. Now, looking at some of the data that's come out over the week, we're wanting to know what's going to happen to our economy and in due course, what's going to happen to interest rates. One of the things that the Reserve Bank was trying to do was stifle spending, stifle inflation, stifle wages growth. But wages are still creeping up, Andrew.
Yeah, interesting. The latest wage index data from the ABS for the September quarter, Michael. It showed another quite sturdy rise over the quarter compared to the June quarter, September compared to June, up by 0.8%. But we did see a big fall in annual wages, which have been tracking at or above 4% for some time, which is historically a very high level. But they fell sharply down to 3.5%, which is a little counterintuitive given how strong our labour market is. And we will be getting the latest labour market out this week that we can look at that. But when we look carefully, the ABS has quite clearly said that fall in the wage index was a result of the Fair Work Commission's annual wage review decision. Its latest decision proposed or mandated a 3.75% wage increase from the 1st of July, annual wage increase, but that was a lot lower than the 5.75% over the September quarter, that decision. So it was that Fair Work Commission annual wage review that pushed overall the wage index down to 3.5%. And Michael, even though we all want higher wages, of course, particularly with high inflation still, or certainly higher inflation still floating around, it's good news for interest rates because high incomes are a generator of inflation, particularly when we don't have the productivity gains for employers to be able to pay those extra wages. So that typically means in a very tight labour market, which we still have, that employers have to raise prices to cover those extra wages. So we get into that sort of price wages spiral scenario. So this is good news that sort of energy looks to be dissipating. And annual wages are still positive in terms of their position over inflation. So real wages are continuing to rise. But as I said, some better news there in terms of perhaps concerns the RBA would have over the, that sort of wages prices scenario occurring. And, we've been tracking at rates, annual wage rates that we haven't seen since the great mining booms of the noughties, Michael. And that's really saying something and tells you how strong our labour market has been. And as I said, that has been causing concern to the Reserve Bank, who would be feeling a little bit better about that latest data, which we should be also, if we're looking for lower interest rates sooner.
Well, what about spending? Are we out there spending, and what's going to happen now that we're coming up to Christmas time?
Well, that's right, and November, Michael, which is sort of
the Black Friday. That's right.
Black Friday has become the new Christmas sales period. So we've got 2 months, particularly November, of strong spending. Maybe that'll work its way into the seasonal adjustment model, but we're still spending out there. The trend's rising, but we've got to understand that because we're looking at the value of retail spending, it is influenced by the inflation rate, and it's also influenced by migration. With more people coming in, that means more people spending and a higher turnover in terms of value. But still ahead of the latest data was still positive, up just by 0.1% over the month, and still up 2.3% over the year. So still, solid retail spending happening out there. And as I said, notwithstanding what's happening with more people coming into Australia and higher inflation rates, and again, just reflecting on what a strong economy we have, Michael, and that confidence is still out there in a positive sense. And we know that because the biggest purchase you can make is a house, and we're still seeing some of those capital cities with high levels of home sales going on.
Well, not only the home sales, but we know people are taking out finance to do that. And we discussed that in previous weeks, that the last month there was $30 billion worth of home loans taken out. So yes, people are out there, and there was depth in the market when we'll talk about that in a moment when we talk about the auction results.
Yeah.
One of the other challenges to inflation has been the cost of building a home. What's happened with the latest figures? I know My Housing Market keeps a careful check on that.
Well, part of the inflation breakout was the home builder policy from the previous government, Michael, which introduced a lot of demand through handouts to consumers. Of course, we didn't have the building materials or the labour to support that, so house building costs particularly went through the roof, and that's a big factor in the house part of the basket of goods that the that the ABS uses for its inflation rate. So we've needed to see that falling as part of putting downward pressure on inflation. We've sort of seen that. The overall costs, the annual costs were. The index costs on house building costs at My Housing Market Run was flat over September compared to the previous month. Still higher than the index is still higher than where it was a year ago. But I think it's interesting, even though we're seeing a reduction in the growth of house building costs, Michael, they're still nearly 50% higher than prior to the home builder allowance. So this is the thing about inflation, and it was part of the story with the American election, was that yes, inflation's falling, not falling per se, but the rate of growth is falling, but prices themselves aren't falling, Michael. They've still got all that energy that was compounded over the past 2 years with high inflation. Same story with house building costs. So even though they're not accelerating as they were, they're still 50% higher than where they were back in 2021. So that's not good news for trying to cover the costs of a new house for consumers. But the annual growth rate is now down to 2.8%, which is well below the 10% a year ago. So we're certainly moving in the right direction, but we're not seeing a reduction in the in costs to build a house. And still at 2.8%, we're well ahead of where we were prior to prior to the COVID period, Michael.
Fortunately, that'll make it a bit easier for builders. We know, unfortunately, many builders went broke because they locked into fixed price contracts, and then all of a sudden the cost of building a home skyrocketed 20% and even 10% last year. This is more manageable, and we need stability in the building industry, don't we?
Yeah, we do, Michael. And look, we're heading in the right direction, but it's still a very expensive proposition to build a house compared to what it was 2 years ago.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Get involved multi-storey dwellings, and once you get cranes and unions involved, apartment towers are just too expensive to build. We've discussed that in previous sessions. Now, we're getting close to the end of the year, but people are still putting their properties up on the market. There were more auctions than we've had for quite a long time. Andrew, how did the market take to over the weekend, the auction market take to the larger number of properties put up for sale?
Yeah, well, only 4 weekends left, Michael, as you said, to the end of the year. So we are in that seasonal mode, the wind down mode, where we do see higher numbers of listings and fewer buyers. And that's just the nature of the beast. It's actually a good time to be buying in the marketplace in terms of the seasonal energy, because obviously a lot of sellers are keen to move their properties before the end of the year. They don't want to come back next year and have to start all over again. So it gives some leverage to buyers out there. And of course, a lot of buyers have actually satisfied their demands over the spring selling season. And what that does is, with the higher listing numbers, it acts to push down clearance rates. And clearance rates are certainly lower than where they were during the mid and early part of spring. But that's what we see every year, notwithstanding what's happening with the cycle, Michael. So a reasonably predictable scenario. But still, we're still seeing high numbers of sales overall, given even with weaker clearance rates, but those high listing numbers. So as we were sort of discussing before, there's still plenty of purchasing going on in the property market, Michael. And last weekend, Sydney, when we look at the weekly results rather than the weekend results, the weekly results, we had 1,400 auctions in Sydney, or over 1,400, more than the weekend before, so a big number there. And Sydney's clearance rate actually increased over the week. And it's interesting when we look at the regional breakdowns, which of course you publish every Sunday. The strength of the Sydney market now is most clearly the higher priced inner suburban areas. We're talking about the lower North Shore, the upper North Shore, which is a little bit further out, but certainly a prestige area, and the eastern suburbs, and particularly the northern beaches. So they all did very, very well. In fact, the northern beaches had a clearance rate over 80% at the weekend. So the prestige markets in Sydney are really what's supporting that market in the moment, and just under 70% clearance rate, but certainly lower than where it was the Sydney rate's been earlier in spring. And can you see the difference in the auction numbers last year over the same week compared to this week? So that's been a trend all year, Michael, really, where we've seen an acceleration of the number of properties being auctioned. And the clearance rate is also higher in Sydney than what it was a year ago. Melbourne, another big weekend of auctions in Melbourne. Its clearance rate fell down. It's interesting, Michael, that Melbourne's actually moving in the opposite direction to Sydney in terms of the types of property that are being sold. Very weak activity, relatively weak activity in the prestige market is continuing. The inner east, the inner south, but particularly the inner east, and particularly the inner city, which has been a real laggard in terms of regional support, Michael, this year. And again, I think it's the third weekend in a row that the inner city has had the lowest clearance rates in Melbourne. And of course, that's certainly a prestige area. And that helped drag that Melbourne clearance rate down to 61.7%. Brisbane, following on what was a holiday the previous weekend, but the Brisbane clearance rates, the auction mechanism in Queensland, in Brisbane, is losing its cachet that it had during the boom last year, Michael. But there we're seeing more typical results of what we understand that, which is a different market for auction activity than the other capitals in Brisbane. Higher clearance rate, 39.6% compared to 40% the previous year. Adelaide's been also a market that's moved from sort of ultra boom mode into a more sort of normal balance between supply and demand, buyers and sellers. 68.5% clearance rate, higher than the previous weekend, but again, well below where it was a year ago in Adelaide. And we remember Adelaide, Michael, was giving us 80% plus clearance rates almost, week after week, which was extraordinary. And Canberra picked up back in town, Canberra, with 59% clearance rate, but it does tend to be quite volatile, that Canberra market. We just really haven't seen a sustained period from Canberra rising above a 60% clearance rate. But certainly that was a better result compared to the previous weekend. And the trends, as I described before, Michael, we're seeing that downward trend in clearance rates, overall clearance, monthly clearance rates, as the spring selling season progresses or winds down, and all capital cities are now recording lower clearance rates over November so far compared to October, but that's what we expect. And if you're looking for those latest results on the weekend or on the auction markets, that we bring them out on Saturdays around about 6:30 p.m. And of course, Michael, you publish the weekly national report, which comes out on Sundays and includes the regional breakdowns for Melbourne and Sydney and the top 10 sales for all the capital cities. So a bit of the same old in the auction markets there, Michael, and it's that seasonal effect that's now starting to work its way into the system as we all start thinking about that holiday break that's coming up very, very fast. In fact, it's only 5 weeks away and we'll all be saying goodbye until 2025.
It's come around very quickly. It seems to be a little bit earlier these years with the Black Friday sales.
Yes.
Already in November, people are in the holiday spirit. I mean, it's nothing to do with the shops where you already see the Christmas decorations out. Over.
Yeah, that's right. I was just going to say that, yeah.
We'll be back next week because there's always still property news between now and Christmas time. Look forward to catching up with you then, Andrew.
Yeah, thanks, Michael.